Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Hyliion stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Hyliion develops technology to help trucks use less gas. The company does not manufacture vehicles like Tesla. Its technology relies on upgrading existing commercial trucks from other manufacturers. The company's focus is on Class 8 trucks, which are the big rigs, the 18-wheelers found all over our highways. They are expensive to buy, expensive to operate, and are very bad for the environment since they emit a lot of pollution into the air. Electrifying big trucks is a win for the environment. It's also a win for the companies that operate these trucks since they would save a lot of money on fuel costs. A concern I have about investing in Hyliion is that the current truck manufacturers are rapidly developing their own Class 8 EV trucks. These companies are established brands that have dominated the industry for decades. In addition to that, EV car makers are also eyeing this market. In order for Hyliion to grow and scale, it needs to partner with a Class 8 truck manufacturer to offer its product as an add-on option. Shortly after the company went public, the stock surged to over $50. That's also during the time President Biden announced plans to achieve net zero emissions. These sentiments were a huge boost to all EV stocks. Hyliion stock is down over 90% from its high point. Currently, the stock is trading below $5. Hyliion was funded by a SPAC. A special purpose acquisition company is formed to raise money through an IPO, then acquire a private business to help them go public. This is also known as a reverse merger or reverse takeover. In October 2020, the merger was completed, and Hyliion received $560 million in cash proceeds. The SPAC that acquired Hyliion was Tortoise Acquisition Corp. The company is headquartered in Cedar Park, Texas, and was founded in 2015. It trades on the New York Stock Exchange. Let's get started with the model. This is a small cap company, 750 million market cap. They're trading at $4.34 a share, and they have 174 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They do have negative free cash flow each year since they're pretty much pre-revenue. They did get their first revenue at the end of 2021, but it was really small. Net income is a profit or loss on the income statement. It's revenue minus expenses, and that's negative each year. This is the company's income statement. The top line is the revenue, the sales. That was $200,000 in 2021. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit. That's negative $2.5 million. Below that is their operating expenses. Their main operating expense is R&D. Below that is their operating income, which of course is negative every year. Below that is the interest they receive on their investments, minus the interest they pay in their debt. It looks like they're pretty much debt-free because they didn't pay any interest in 2021. They received $779,000 on their investments. Last year, they paid $5.5 million of interest. Then below that is other income and expenses. These are all the gains or losses not part of the company's core operations. An example is an asset impairment. And the bottom line of the income statement is their net income, which is negative every year. This is their income statement from their 10K. And this gives us a little more info than Yahoo Finance. It starts with their revenue, then cost of revenue. Their main expense is R&D at $58 million. Last year was $13 million. Then you have selling, general, and administrative expenses. This includes marketing and payroll. That was $35 million. Last year was $10 million. They didn't pay any interest on their debt. Last year was $5.5 million. Before that, it was $3.3 million. Their net loss in 2021 is $96 million, but they did have a net profit in 2020 of $324 million. That was from the gain in the fair value of warrant liabilities. This is a non-cash item, so it doesn't affect cash flow. Warrants are like long-dated options. Since the stock went up so much in 2020, it gave the holder of the warrant the option to convert that to equity. which does dilute the current shareholders. You can see their shares outstanding in 2019 was 86 million, then 104 million, then 172 million. Their basic EPS was 311. The diluted EPS was negative 0.35. That's because these warrants really diluted the shareholders. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company loses from its operational business. They spent $2.4 million in CapEx. These are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. And of course, they have negative free cash flow each year. So they're mainly funding their business on stock. They added $17 million of debt in 2019 and $4 million in 2020. This is their operating cash flows from their 10K, and this shows us 2019, 2020, and 2021. The way to calculate operating cash flow, you start with your net loss, then you add or subtract the non-cash items on the income statement, adjust for changes in working capital. So even though they reported a net loss of $96 million, they lost $81 million of cash flow in 2021. In 2020, they have a net gain of $324 million, but had a $23 million loss because that big gain of warrant liabilities on the income statement has to be minused out on here since it's a non-cash item. This blue line is their revenue, which is pretty much nothing up through 2023. At least that's a forecasted. But the company expects to have $225 million of revenue in 2024. If they do that, they'll have positive operating cash flow. This is the company's investing and financing sections in their statement of cash flows. And they have a lot going on in the investing section. But these investments are actually investments in short-term liquid securities. A lot of companies do this so they don't sit on cash and earn nothing. When you invest in commercial paper or treasury bonds, you do earn a small interest rate. A bulk of it is corporate bonds, $74 million of commercial paper, then they have state and muni bonds and US government bonds. They have so much cash from going public. In their financing section in 2020, they received $560 million from PIPE financing. This is when the SPAC acquired them. That stands for private investment in public equity. And they also received $124 million from warrants. In 2021, they received $16 million from warrants. So in that year, they received $16 million of cash in their financing section. Last year was $645 million. This is the equity section on the 12/31 balance sheet. They have $554 million of equity. They raised $375 million from selling their business. And they have positive $179 million of retained earnings. Retained earnings is a sum of all your prior net incomes, but they're definitely cash flow negative. The only reason they have positive retained earnings is from those warrants. Let's look at the capital structure. $554 million of equity, $9 million of debt. They're 98% equity, 2% debt. And they could pay off all the debt with the cash on their balance sheet and still have $369 million of cash left over. This blue line is their equity balance since 2019. The green line is their cash balance, and the red line is their debt balance. So they pretty much paid off all their debt, and that cash balance went up similar to their equity balance because they're just sitting on a lot of cash. I gave them the highest whack on Finbox, 7.8%, and that's a discount rate we're going to apply to the future cash flows. We estimated 5 years of future free cash flows. We also estimated terminal value, which is all cash flows. Past year 5, that's $1 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $670 million. We divide that by 174 million shares. And we get a calculated stock price of $386. They're trading at $434, so they're trading at a 12% premium. It's a sell according to the model. The last time I did a video on this company was in December of 2021. They were trading at $656 and my valuation was $352. They've come down about 40% since this point, but they're still trading above my calculated price. And it looks like my new calculated price has come up a little bit since my last one. When the company reported their 2021 results, they said revenue in 2022 should be $2 to $3 million. My revenue forecast for 2022 is $2.5 million. It's rounded up to $3 million. The forecast is for them to have $23 million of revenue by 2023, then $225 million of revenue in 2024. And then I doubled their revenue the next 2 years. The average company in their industry converts 6% of their revenue into free cash flow. So I multiplied their 2026 revenue by 6%. That's how I got their future free cash flows for that year. And I assumed they would have negative free cash flow before then. 3 analysts priced this stock, and the low is 4, the high is 5. You can see right out of the gate, the stock went up a ton. It made the CEO a billionaire, but it's come down over 90%. I think it's about 92% since the peak. If you invested in the S&P 500 when this company started trading, you'd be up 40%. With this company, you'd be down 56%. But at one point with this company, you would have been up over 400%. Here are some recent comments the company made. They received orders from multiple fleets totaling 100 units. Reservations for 325 units. The company provided these bullet points when they released their annual 2021 numbers. This article was really recent from 3/22. Moen Transport makes a reservation for 20 units. This is from a few weeks ago in February. Green Path Logistics orders 50 Hypertruck ERX units. If you wanted to buy a big rig with Hyliion's product added on, you'd have to pay $90,000 more than a big rig with a regular engine. You would need to drive that truck a ton of miles to make that $90,000 back. They have a beta of 0.92, so the stock pretty much moves with the market. It's down 59% in the past 52 weeks, while the S&P is up 14%. The 52-week low is 330, the high is 14. And the stock is trading between its 50-day and 200-day moving average. 2.5 million shares are traded each day on this stock. Of the 174 million shares outstanding, 115 million are on float, 31% are held by institutions, and 12.5% of the shares are shorted. Their employee count has been growing. They currently employ 200 people. If you invested $10,000 into this company when it started trading, at one point you would have been at over $50,000. But if you're still holding on, you'd be at $4,400, a 56% loss. In the past 12 months, there's been a lot more insider selling than buying. Only 25,000 shares have been purchased, but several million have been sold. Here's a list of the insider buying and selling, the date, the person or company, the number of shares, and the price. 38% of the companies held by the general public, 28% by institutions, 24% by insiders, 5.5% by venture capital and private equity firms, and 4% by private companies. The founder and CEO, Thomas Healy, owns 19% of the company. His value is $144 million. At one point, his value was over $1 billion. The next biggest shareholder is Vanguard, then Cole Capital, BlackRock, and Flying J Corp. Let's look at their financial ratios. We can't look at the PE since they have negative net income. They have a really bad price to sales ratio because they have hardly any sales. They do have a good price to book because they raised so much cash from the IPO. Price to book is stock price over book value per share. Let's look at their non-current assets. 2.2 million of property and equipment, 7.7 million of operating leases, right of use assets. These are assets they leased that are owned by another company, so they're reported on the balance sheet as an asset and liability. 200,000 of intangibles, 1.5 million of other, and 180 million of long-term investments. We looked at those earlier. Let's look at their non-current liabilities. They owe 8.6 million on those right-of-use assets and 700,000 of other. They have a really high current ratio of 25. That's current assets over current liabilities. And their quick ratio is the same at 25. Let's look at their current assets. 258 million of cash, 9 million of prepaid expenses. This means they made an advance payment for a product or service they're going to receive in the future. And they have 119 million of short-term investments. These are commercial paper and corporate bonds. Let's look at their current liabilities. 7.5 million of payables. This is how much money they owe others. And 8 million of accrued expenses. These are expenses the company has incurred but has not paid it yet. In 2021, they had negative 83 million of free cash flow, but they do have 371 million of working capital. So it looks like they have enough cash on their balance sheet to get through 2022 without adding any more debt or equity. The best way to look at ratios to compare them to companies in the same industry. There are 50 companies in the same industry as Hyliion, and Hyliion is ranked 28th in market cap. And they're pretty much pre-revenue at this point, so it's really hard to look at all their ratios. They're much worse than average in almost every category. They are better in price to book because they have so much cash on their balance sheet from the IPO. So to summarize, I have them trading at a 12% premium But I'm sure almost anyone will be supportive of what this company does, trying to make the world a greener place by reducing all the pollution those big rigs give off. And also, those companies are going to save a lot of money in gas prices. But they're not selling trucks. They're selling a product that's an add-on feature to a truck. So they really need to work with truck manufacturers. That's really the only way they're going to scale and grow. They could work with trucking delivery companies, especially big companies with lots of trucks. They might be able to afford adding their feature onto their trucks. But there's definitely a lot of competition in this space. You have a lot of EV companies out there already, like Tesla, NIO, and there's also big companies like Ford and GM. But maybe they could license out their technology to a company like Ford. Only time will tell. I rank their free cash flows, revenue, and ratios 1 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.